Next guest expects this rally to continue through year end. Joining us with the charts is Ari Wald. He's Oppenheimer's head of technical analysis. And Ari, this is a moment when a lot of people are going to say, I missed out, or it's too late, or I'm going to buy in and it's going to go the other way. So I'm glad you're here. And what do you see? What jumps out to you?
Well, I'm reminded of market watcher Paul Montgomery's line, which is that he said the most bullish thing the market can do is go up. I mean, let's take notes here, Kelly. We got new highs in cap-weighted S&P, equal-weighted S&P, NASDAQ 100, Russell microcaps, Russell 2000 small caps. We got risk-on leadership in the financial sector and the industrial sector as well. We got credit spreads reaching new, its narrowest spreads of the cycle. We got interest rates moving higher and seasonally strong tailwinds coming behind us in November, December of an election year, typically where you see a year-end rally. From my view, these are the conditions that are consistent with an upcycle that should extend into 2025. Stick with the market, buy pullbacks. The bull cycle is intact here.
It's obvious that the Russells are playing more catch up than, for instance, the Dow or even the NASDAQ. What does that tell you? Or do you worry about it? I mean, do you stick with things broadly, or do you go for the places where there's the most momentum, like the regional banks, like Bitcoin, like the small caps? I mean, I just, it's, I guess it's the cynic or the pessimist in me that is afraid that you look at some of these moves and you jump in and they're just pulling forward a lot of future gains.
There is some of that, and that's why we have to stick with our methodology. We have to stick with our discipline. We are momentum investors that are relaying technical analysis on top of our process. And so as far as the areas that exhibit strong momentum, again, in thinking about these Trump trades, U.S. over world makes a lot of sense to us. These world markets hitting new multi-decade relative lows. For the at the sector level, I think it's sticking with financials, industrials. These have been sectors that have been overweight in our work for the entire year, just given the broadness of strength in capital markets and infrastructure on the industrial side as well. Conversely, I suppose small caps we're using more as a market signal. I still prefer the relative strength in large and mid cap stocks, but the fact that small caps are working, I think just continues to give us conviction that the trades that we do like should continue to work. Because if there is going to be a rollover, it probably does happen in that small cap index first.
And the momentum going into year end, the last several years, I would ask traders about this and say, well, when everyone, 2022 is a different story. It was a weak market in October and it got, did it get weaker? I mean, but otherwise we've seen such strength. And is there any reason to believe we're not going to have a repeat of that pattern? Of strength in a rally, in a run, kind of right into the end of the year?
I think it's set up that way because here's how you have to think about it, Kelly. There's what the roadmap, kind of historically speaking, what has happened. Typically, there's strength, not only in Q4, especially in an election year, and then what is happening now. You can't just go based on seasonals and historical patterns alone. But when what is happening in the market right here, right now, is confirming that roadmap, it does add to our conviction here. So, again, we had a downtick in October. Market's down 1%, again, historically consistent with that roadmap. Now they're starting to break higher into the seasonal strong patch. I think the setup is there as we move into the third year of this bull cycle, which in our view is really just starting to attain some of those average thresholds. I would argue that we haven't reached overvalued levels just yet either.